Interest rates play a crucial role in shaping the economy and the real estate market. They determine the cost of borrowing money, which in turn affects how businesses operate, how much they invest, and how many employees they hire. When interest rates are low, businesses find it easier to access capital, allowing them to expand, hire more workers, and increase production. This creates a ripple effect, boosting consumer spending and overall economic growth. Conversely, when interest rates rise, borrowing becomes more expensive, leading businesses to cut back on spending, slow down expansion plans, and in some cases reduce their workforce. In the real estate sector, the cost of money has a direct impact on investment decisions. Investors and home buyers rely on loans to finance property purchases, and the interest rates on these loans determine their affordability. When rates are low, monthly mortgage payments are more manageable, allowing people to buy homes at higher prices while maintaining the same budget. This often leads to an increase in property values as demand rises. However, when interest rates climb up, the cost of borrowing rises with them, making it more expensive to finance a home or investment property. As a result, demand decreases, which can slow down price growth or even cause a decline in property values in some areas. Over the past several months, interest rates have seen a sharp increase. The Federal Reserve has raised rates multiple times in an effort to control inflation, and it has signaled that further hikes are likely before the end of the year. This has had a significant impact on real estate, particularly in the residential and investment property markets. For investors and homebuyers alike, understanding these changes and adjusting strategies accordingly is essential for making smart financial decisions in a shifting market. The recent increases in interest rates have affected different types of real estate in varying ways. Some asset classes have seen dramatic changes in financing costs, while others have been less impacted. Understanding these differences can help investors make informed decisions about where to put their money in the current market. One of the most significant effects of rising interest rates has been on owner-occupied home financing. Just a year ago, home buyers could secure mortgage rates as low as 3.25 to 3.5%, making homeownership relatively affordable even with high property prices. However, as interest rates have increased, mortgage rates have jumped to around 7.25%. This may not seem like a drastic change at first glance, but in reality, it has had a major effect on affordability. For example, a home buyer who is paying around $2,000 per month for a mortgage at a 3.5% rate would now need to pay significantly more at the new 7.25% rate, even if the loan amount remained the same. This increase in monthly costs means that many potential buyers now struggle to afford the homes they once considered, reducing demand in the market. As demand falls, home price appreciation is likely to slow, and in some areas, prices may even decline as sellers adjust to the new financial reality. Smaller investment properties, such as single-family rentals, duplexes, triplexes, and fourplexes, have also been significantly impacted by rising interest rates. 6 months ago, investors could secure financing at rates as low as 5.75% to 6.25%, making it possible to generate solid cash flow even with high property prices. However, those same loans now come with interest rates of around 7.5%, marking an increase of nearly 5%. This sharp rise in financing costs has made it more difficult for investors to achieve their desired returns. Higher interest rates mean higher monthly mortgage payments, which eat into rental income. As a result, investors need to be more selective when purchasing new properties, focusing on those with strong rental demand and potential for rent growth. Some may also choose to wait for property prices to adjust downward before making new purchases. Larger multifamily properties, such as apartment buildings with 5 or more units, have been somewhat less affected by interest rate hikes. 6 months ago, investors could secure financing for these properties at rates between 4.25% and 5.5%. Today, those rates have increased to around 6.5% to 7.6%, which is still a notable jump but not as drastic as the increase seen in the 1 to 4 unit market. One reason for this smaller increase is that commercial lending tends to have different underwriting standards and loan structures. Many multifamily investors use 5 to 10-year fixed-rate loans rather than traditional 30-year fixed mortgages. This allows them to secure lower interest rates, though they may need to refinance sooner than a typical homeowner. While financing costs have increased, demand for rental properties remains strong, and rent prices continue to rise in many markets. This has helped multifamily investors offset some of the impact of higher interest rates, making these properties a more stable investment option in the current environment. With interest rates on the rise, real estate investors need to be proactive in adjusting their strategies. Simply continuing with the same approach that worked in a low-rate environment may no longer be profitable. Instead, investors should consider different ways to reduce borrowing costs and maintain strong cash flow. One effective strategy is to shift focus to different asset classes. Since multifamily commercial properties have seen smaller interest rate increases than smaller rental properties, some investors may find it more beneficial to move their investments toward larger apartment buildings. By doing so, they can secure better financing terms and benefit from continued demand in the rental market. Another approach is to explore financing options that help lower interest rates. One way to do this is through rate buy-downs, where investors pay additional upfront fees to secure a lower interest rate over the life of the loan. While this requires more capital at the beginning, it can save significant amounts of money over time, especially for long-term holds. Investors can also consider using adjustable-rate mortgages or ARM or interest-only loans. These loan types often come with lower initial interest rates compared to traditional 30-year fixed loans. ARM, for example, have a fixed rate for a set period, such as 5 or 7 years, before adjusting to the market rate. If an investor plans to sell or refinance before the rate adjusts, this can be a cost-efficient solution. Similarly, interest-only loans allow for lower initial payments, which can improve cash flow in the short term. Additionally, investors should negotiate loan terms with banks and lenders. Different lenders have different programs and incentives, and by shopping around, investors can often find better deals. Some banks may offer lower rates on shorter loan terms, while others may provide discounts for experienced investors with strong financials. Finally, investors should consider alternative investments that offer better cash flow potential. For example, focusing on properties in markets with strong rent growth can help offset the impact of higher borrowing costs. Similarly, investing in properties that can be improved or repositioned to generate higher rental income can increase profitability, even in a high interest rate environment. The rapid increase in interest rates has changed the landscape for real estate investors and home buyers alike. While borrowing costs have risen significantly, there are still opportunities for those who adapt their strategies accordingly. By understanding how different asset classes are affected, exploring alternative financing options, and focusing on investments with strong income potential, investors can continue to grow their portfolios despite the challenges posed by higher interest rates. The key is to remain flexible, stay informed about market trends, and make adjustments based on the evolving financial environment. If you're looking for personalized guidance on navigating the current real estate market, I'm here to help. Visit my website from the description box below to learn more about investment strategies, market trends, and financing options. Don't forget to like this video, subscribe to our channel, and hit the notification bell so you never miss out on valuable real estate insights. Drop your questions in the comments below. I would love to hear from you. Thanks for watching, and I'll see you in the next video.